All right, let's get right into it. The guy who basically kicked off the whole meme stock craze, Keith Gill, you probably know him as Roaring Kitty, is now at the center of a huge federal class action lawsuit. So today, we're going to break down exactly what that lawsuit says he did. And it all fired up again with this. A super simple, kind of cryptic sketch he posted after being silent for 3 years. You wouldn't think it, but this one little drawing set off a massive rally in GameStop stock. And, as this lawsuit claims, it was the first move in a very calculated plan that's now landed him in some serious legal hot water. So first up, a kitty roars again. We're going to look at his big return to social media and how the lawsuit paints a picture of his, well, pretty incredible influence over the market. Okay, so the main character in this whole story is, of course, Keith Gill. But the lawsuit makes it really clear he's not just some random guy tweeting. No, he's Roaring Kitty. He's that celebrity investor from the 2021 GameStop saga, a guy who used to be a registered stockbroker, and he has a massive, massive online following that hangs on his every word. And just how big is that following? The lawsuit puts a number on it. By June 2024, he had over 1.6 million followers on X. Now, why does that number matter? Well, it's all about reach. The complaint uses this to argue that his posts aren't just opinions. They're powerful enough to actually move markets. And this slide, this really shows you the core of their argument. The complaint draws a straight line from that post he made on May 12th to what happened next, a huge, immediate spike in GameStop stock price. The allegation is pretty simple, really. One caused the other. Period. All right, next up, the frenzy and the fortune. Now we're getting into the nitty-gritty of the actions Gill took that the lawsuit says were meant to artificially inflate or pump the price of GameStop stock. And the numbers here, which are pulled right from the complaint, are pretty wild. So on May 10th, before any posts, the stock is sitting at about $17.50. The very next trading day, it shoots up 74%. By the 14th, it's up a staggering 179% from where it was just days before. The lawsuit presents this as Exhibit A for the impact of his posts. Okay, to really get the next part, we need to know what a call option is. Think of it like this. It's a contract that gives you the right to buy a stock at a locked-in price for a certain amount of time. So why are they a big deal in this case? Well, because they let you bet on a huge amount of stock for just a fraction of the cost. If the stock price goes to the moon, your profits are absolutely massive. And the lawsuit says that's exactly what Gill was counting on. Then, on June 2nd, he really turned up the heat. He posts this screenshot on Reddit, and it shows he has a position in GameStop that's just massive. We're talking 5 million shares and 120,000 of those call options. The total value at the time? Over $200 million. According to the complaint, this was like pouring gasoline on an already raging fire. So how did his followers take it? The lawsuit points to posts just like this one. When people see him holding, they post things like, "If he's still in, I'm still in." And the lawyers argue this is proof that his followers saw these posts as a rallying cry, a signal for them to buy and hold GameStop, no matter what. And that brings us to the absolute heart of the allegation, the thing this whole case is about, the pump and dump. So what exactly is a pump and dump? It's a classic form of securities fraud. Basically, you hype up a stock you own to artificially inflate or pump its price. Then, once everyone else has bought in and the price is high, you sell or dump all your shares for a big profit, leaving everyone else holding the bag. And the complaint lays out what it calls Gill's 4-step plan. Step 1, before saying anything, quietly buy up a ton of those GameStop call options. Step 2, start the pump with his big social media return on May 12th. Step 3, pump it even higher on June 2nd by showing off his gigantic position. And the final step, the dump. Sell all 120,000 of those call options for what would be a massive profit. Now, the whole thing hinges on timing, right? The lawsuit points to this Wall Street Journal report, which claims that Gill bought up all those options just before he kicked off the new craze. This is key because it suggests his actions weren't just random, they were premeditated. And you could argue this slide is the smoking gun, according to the lawsuit. On the left, there's his portfolio from June 2nd, showing those 120,000 call options. But on the right, look at the portfolio from June 13th. The options, they're gone. The lawsuit claims this is the dump. And notice his share count jumped from 5 million to over 9 million. The implication is he used the profits from selling the options to buy even more stock. So, finally, let's talk about the aftermath. The real-world consequences of all this. The legal fallout. Yeah, the response was pretty swift. The lawsuit mentions that his own broker, E-Trade, was thinking about kicking him off its platform over manipulation concerns. Then, the Massachusetts Securities Division, his home state regulator, opened an inquiry. The SEC started looking into all the trading activity, and all of that led to this, a federal class action suit filed for all the investors who bought GameStop stock during that wild one-month ride. Which really leaves us with the billion-dollar question, doesn't it? Is he a folk hero, the champion of the little guy fighting Wall Street? Or, as this lawsuit alleges, is this a clear-cut case of financial fraud? Well, all the pieces are on the board now, and it's up to a U.S. court to figure it all out.